Welcome to John Insights. Wall Street is quietly getting worried about AI stocks, and most people aren't paying attention. Not that long ago, if a company announced they were dumping money into AI, that stock would boom on the news. Now that's changed. Let me show you what I mean. End of 2025, Meta announced a $30 billion investment into AI infrastructure. Their stock saw its worst day in 3 years, falling 11%. But that's not all. Oracle is seeing the same thing. Oracle is dumping so much money into AI that Barclays says they're going to run out of cash by November 2026, and their stock is feeling the pinch. Wall Street is changing their stance on how they invest in AI stocks, and this matters not just to people investing in AI or tech, but to everyone with 401k accounts, everyone investing in the S&P 500, everyone with money in the stock market, because this is going to have a broad impact on all investors. The reason why? The S&P 500 is so heavily weighted by a few tech companies with massive AI influence. The Magnificent Seven: Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla. Those 7 companies make up more than a third of the S&P 500's weight. The other 493 companies make up the other 2/3, which means if one of these tech companies gets hurt, it's not just that stock that gets hurt, it's the entire stock market. It pulls down the entire market. It pulls down 401k accounts. People are hoping and praying that these AI companies keep growing at very good speeds, because if they don't, that can hurt broader markets. Now Wall Street is starting to get concerned, not just about the technology of AI, but more specifically about debt, the amount of debt going into AI. Bank of America just put out a report saying these tech companies are anticipated to spend 94% of their operating cash flow on AI infrastructure. They're spending almost every dollar they make back into AI. Somebody will succeed, but some of them will not. And when they stop succeeding, that is going to have a painful effect on the market. The concern is more specific than that. Tech companies in 2025 borrowed $121 billion. That's hard to fathom, but here's why it matters. That's 4 times the average they've borrowed over the last 5 years. So not only are they spending more on AI, they're borrowing significantly more dollars on these AI investments. And some of them might not pan out. If you're borrowing so much money and you don't see a return, that's going to have a consequence. Some companies are not going to succeed. And this is the concern Wall Street is now pricing in. Certain companies that invest in AI have no clear path to revenue or profitability. Oracle, I talked about them at the beginning. They're borrowing so much money now that their bonds are trading like junk bonds. Oracle is a huge tech name, but because they've borrowed so much, investors are concerned about their ability to pay this money back. They're demanding junk bond interest rates. But not just that. Oracle's credit default swaps are essentially saying, we believe Oracle is going to default. They're going to go bankrupt. These credit default swaps, these insurance contracts, are now at the highest levels we've seen since the 2009 financial crisis. People are not confident in their ability to continue paying back these debts. Why? Because they're putting all this money into AI. If you had said this 12 months ago, people would have said, they're putting their money into AI. They're going to make so much money. They're going to be the most valuable company in the world. Today, because they're putting their money into AI without a clear path to profitability, investors are being more picky. They're saying, we don't want to own that. It's a very clear difference today than where we were 12 months ago. And it's changing how investors look at AI stocks. Now, to be clear, this doesn't mean there's no value in AI. It's a shift in how companies and investors are looking at AI. Some companies have a clear path of revenue with AI. Goldman Sachs pointed out in their most recent report that in 2025, AI stocks all essentially moved together. There was an 80% correlation. If one AI stock went up, 80% of AI stocks also went up. Today it's 20%. Investors are not looking at all AI stocks the same. They want to see which companies are actually seeing growth. Amazon, they're using their AI to directly generate revenue. When AWS grows, AI grows, they make more money. So when Amazon announces they're putting money into AWS, their stock has been benefiting, versus when Meta says it, because there's no clear path to profitability. Maybe they can use AI to run better ads, but there's no clear path. Their stock got hit when they said they were investing so much money into AI. Same with Oracle. And this is where history doesn't exactly repeat itself, but it does rhyme. We can look at what happened in the 1990s leading up to the dot-com bubble bursting. We're seeing some similarities today. In the 1990s, companies were borrowing billions of dollars. Why? Because they wanted to be a winner in the internet race and in the fiber optic race of building these internet infrastructures for what was coming in the 2000s. The infrastructure is still used today, but not every company is around. Some companies borrowed a lot of money and saw huge success. Other companies borrowed a lot of money trying to win, but went bankrupt. And that might be what we're seeing now. Not every company will be able to survive. And that's what Wall Street is starting to realize. And that's what you want to prepare for. It doesn't mean AI is going to go away. It doesn't mean AI doesn't have value. It doesn't mean you can't monetize AI. But it means that when companies are borrowing insane amounts of money to hopefully win in AI, more companies will fail. Because debt ultimately increases risk, and some companies are not going to be able to service all of that debt. So what does this mean for you? If you're an investor, especially if you're looking at tech stocks that involve AI, here are a few things you want to pay attention to. Number one, pay attention to free cash flow. If more companies are going into negative free cash flow, meaning they're spending all their money and then some for their AI investments, that's a big risk. We're seeing more and more companies do that today. Number two, look at credit spreads. If a company is borrowing money to do the AI investment, look at how investors are valuing these loans. Oracle is borrowing money for their AI investments, but investors are looking at them like junk bonds. They don't believe Oracle is going to pay back, which is why they're demanding such high interest rates. If you're looking at investing in a tech company, take a look at what their bonds are doing. Look at these credit spreads. That way you can get an idea of how investors are valuing their debt. Number three, look at their AI revenue and AI revenue growth. Companies that are going to see growth in today's economy need to actually be able to make money off their AI. If they don't have a path to profitability, their stocks are getting hit when they invest more money in AI. Because it's much more speculative, and investors are paying attention to that. And number four, the big one, is taking a look at slowdowns in spending. That's going to indicate they're running out of money and getting desperate. Through 2025, companies had access to unlimited amounts of money. If you were creating something with AI on the back of it, investors were dumping money, throwing money at you. They still kind of are, but they're getting more picky. If that trend continues, and some companies now have to slow down spending because they've overspent into AI, that could be a big red flag. So if you're an investor in these tech companies, pay attention to those four things: free cash flow, credit spreads, AI revenue growth, and spending patterns. Now, generally, what does this mean? Does this mean you shouldn't invest your money? No. What this means is if you're an investor, be a long-term investor and know your game. If you're a long-term investor, this doesn't change anything you're doing so long as you're investing in a good company. But it also means opportunities might be ahead. We know AI is not going away. I can tell you that from firsthand experience. I'm seeing how fast AI is growing and how it has changed businesses. Businesses are using AI more than ever, but a lot of businesses still aren't touching AI. That's a huge opportunity. AI is going to grow. But every company wants a piece of this new economy, this AI economy. And a lot of these companies don't have enough money in their bank account to fund this growth. So they're going into debt. They're borrowing against their assets to try to capture a piece of that growth. Some of these companies that are borrowing are going to succeed. Some of them are not. And when the first big one goes bust because they've overborrowed, they've overleveraged, and they cannot continue the spending, that is going to trigger panic. When people see a big tech company go bankrupt because they couldn't make the AI thing work, it is going to instill some fear. But that is where the opportunity is going to be. And a lot of people don't want to say that, but in reality, that creates some of the best opportunities out there. Because recessions and market crashes create more opportunities than any other time. They allow financially savvy investors to come in and buy at a discounted price. You don't need to wait for a downturn to come in and buy. But if you're an investor and you believe in the future of technology, understand that debt creates opportunity. Some companies are going to be able to use that debt profitably. Some are not. Some are not going to be able to out-earn all the debt they took on. When that first company goes down because they borrowed too much and they couldn't access more capital to continue their spending because they couldn't monetize the AI, some people are going to get scared. They're going to say this is the end of the AI bubble. People are going to start panic selling. But that is where the opportunity is also going to be. If you have access to cash and you know how to analyze investments, that's what I want you to pay attention to. There's going to be a lot of crazy headlines. People invest based on the news. They should be investing based off research. They don't pay attention to what's actually happening in the economy, and they're not long-term investors. They become traders even though they say they're investors. So if you're an investor, understand what's happening. Wall Street is changing how they invest their money into AI stocks. Be smarter with your investments. If this video helped you understand what's happening with AI stocks and Wall Street's changing stance, do two things. Hit the subscribe button so you don't miss the next breakdown, and share this with a friend, family member, colleague, or fellow investor. The more people understand how this actually works, the better decisions they'll make.